This is part 3 of the 3-part recording. Again, sorry that I am not with you in person. I'm stuck in Los Angeles on a deal. So I'm recording this part 3 at about 5:30 in the morning Los Angeles time. It's dark outside and it looks like the sun is just starting to come up, so it may get a little bit lighter during the course of this. But what I wanted to do is I wanted to go through the projections so you'll have a better understanding. A bunch of you have asked via email what is expected in terms of submitting projections. So we're going to go through that, and I'm going to show you what at a minimum your projections and analysis should look like for the group project and for your submission. So I'm going to share again the Excel file that we've been using in class, which is available on the Canvas module. Okay, so this should be appearing on the screen, and this is the same model that we've been using. So here there's 250 rooms. Right, and we have occupancy of 64%, growing to 74, to 80, to 83. Okay, I can make up those projections, but I have to have a reason for that level of growth. Same thing, we start the ADR at 230, it grows 15% in year 2. That might be aggressive, it might not. It depends on how conservative year 1 is. And we've spent a whole bunch of time going through all the line items on this page. So your projections for your group project should look like this. Okay, there should be 5 years of projections, where year 1 is the first year of operations. Remember, year 1 is going to be 2027 because we're assuming construction during 2025 and 2026. Okay, you need to show the dollars, which you can show in actual dollars. These are shown dollars in thousands, and it's done just so that there's more room on the page and you can actually see this printed out or on screen, and the margins. So to recap, for revenue, what we show here is the room revenue divided by total revenue. In the departmental expenses, we're showing the rooms expense. So rooms expense is 30% of rooms revenue, not of total revenue. Departmental expenses are calculated as a percent of departmental revenue. Here, food and beverage revenue is the food and beverage expense divided by food and beverage revenue. Same thing with other. When we come down to the undistributed expenses and the fixed expenses, here this is calculated, admin in general is 9% of total revenue. So again, departmental expenses and departmental profits are calculated as a percentage of departmental revenue. Undistributed expenses are calculated for margin purposes, here the 9% expense margin, as a percent of total revenue. Okay, so for each one of these, same thing with these undistributed and fixed expenses. So insurance is 2% of total revenue. Base management fee is 3% of total revenue. And same thing for year 2, year 3, year 4, year 5. What you should all be doing is looking and seeing, are there big jumps or big declines in the percentages that you're using in the margins or in the actual dollars? And if there are, you'd want to understand why. As an example here, property taxes are 2.5%, then 3, then 3.5, then 4. Okay, this is an assumption, and the assumption made is that the property tax assessment will be lower when we're first open, and that the property tax assessor will be assessing us higher as time goes on. Okay, and we have the FF&E reserve also calculated as a percent of total revenue. Okay, and the net operating income, as we've talked about in the past, is EBITDA minus the FF&E reserve. Okay, the FF&E reserve is not an actual expense, but it's dollars put aside so that when we need to do renovations, there's a bucket of money there and available. So you should have a 5-year projection that looks something like this. Doesn't mean the numbers look like this, but this format. years 1, 2, 3, 4, 5. Then you should have the next tab as well. Okay, it's the same dollars in year 1, 2, 3, 4, 5, but instead of margins and percents of revenue, we have per occupied room. Okay, so this here $230 is the room revenue per occupied room. This is the room's expense per occupied room. Sorry, the $69 is the year 1 room's expense per occupied room. Okay, so what is that? It's $4 million, $4,030,000 divided by 58,400 occupied rooms. How do I get 58,400? That's 250 rooms at a 64% occupancy, right? So the number of occupied rooms is going to increase each period. See that? So same thing, we can look here and look, for example, at the room's expense per occupied room, $69. It goes to 74, then drops to 68, then to 62, then up to 64. So this would cause someone to raise their hand and figuratively and say, well, why is this going up and then going down? It might go up because some of the room's expenses are tied to the room revenue and the ADR, but then why would it go down, right? You'd want to have an explanation for what's causing sort of an increase or a decrease other than just inflationary expense. When we look at admin in general, which again has general manager, has security, has accounting, has credit card commissions, it's flat at $29, finally goes to 30. Does that make sense? So what that is saying is that as the revenue is increasing, the admin and general expense is not, even though credit card expenses would increase, and there might be increases in annual salaries or benefits or bonuses, in security costs and in various other contract costs. So does this make sense? So why is it at 29, 29, 29 per occupied room? Let's look back at the first page of projections. That's because I'm assuming that as a percent of revenue, it starts at 9%, goes to 8, then 7.5, then 7. Is that realistic? Right? That's the question. There is no right or wrong answer to that question. It would make sense for it to decline as the revenue increases, as occupancy increases and ADR increases, because we do not need to hire an additional general manager when we have more revenue. We do not need to hire an additional, security person. We do not need to hire an additional chief accounting officer or director of finance. So there are efficiencies that you start to realize as you move forward. Does that mean that we would be able to keep the cost per occupied room flat? You have to tell me. Maybe yes, maybe no. It's not inconceivable. But what that would tell me is that the property operates more efficiently at a higher occupancy and higher ADR, which is intuitive. So same thing, we have the sales and marketing expense per occupied room, 29, 29, 31, 32, right? So it goes up a little bit. Should this go up more? When you look at all of this, what this is showing is the total NOI per occupied room is going from 71 to 92 to 113. Now, in real life, not everything always goes up and goes up simply and easily, but there should be an understanding as to why. One of the reasons why expenses are going up is, again, we see property taxes at $8 per occupied room, then 11, then 14, because if you remember on the previous tab, my assumption was property taxes were 2.5% of revenue, but growing over a few years to 4% of revenue. So again, you should have this first page of projections that we're looking at. You should have the projections per occupied room for all 5 years. And then lastly, you should have the projections per available room for all 5 years. So what does this show? Same exact dollars, And when we show revenue per room revenue per available room, right, it's 13,432,000 divided by 250 rooms. Okay, so this does not factor in occupancy, right? You could be 30% occupied, you could be 70% occupied. The calculation is using the full 250 guest rooms. Okay, and per available room, you're going to do the same analysis, right, and see if the per available room numbers go up meaningfully or not. So even though we saw before the admin and general per occupied room stayed about flat, here per available room, it's 6,700, 7,800, 8,500, so it's growing pretty meaningfully. Per available room is used most importantly for insurance, right? Which right here we have 372,000 or 1489 per available room, and property taxes. Why? Because the property tax assessor pays a little bit of attention to how much your occupancy is, but pays a lot of attention to how many rooms you have and what your square footage is. And once stabilized, right? Once stabilized, whether you're 10 points higher or lower occupancy, they're probably going to assess you with the same property tax. Similarly, insurance, remember, this is not health insurance. Insurance here on the P&L, on the income statement, is property and casualty insurance. It's insurance for the building. It's insurance in case someone gets hurt at the building, if there's a flood, a fire, something breaks down, roof leaks, whatever that is. Remember, all of the health insurance and health benefits for employees are in the individual line items. So health insurance for the director of sales and a salesperson is going to be here in the sales and marketing expense line item. Health insurance and benefits for a housekeeper or for the front desk manager is going to be in rooms expense. So this insurance is only for property, for the property and the building. Okay, so again, the most important PAR, per available room statistics, are insurance and property taxes. We like to look at all of these to see if any unusual patterns pop out. But again, this is going to be most useful for insurance and property taxes. Okay. What else should we have? You should have in your projections package and in your group project an analysis that looks something like this. It doesn't have to be in this format, but I think this is easy to follow. What this does is it takes the competitive set ADR, right, which we have through 2024, and this links to the STAR report, right, the trends report, and the custom P&L report. And then we're growing it at a growth rate that I pulled from the CoStar projections. You could have different projections and think that ADRs are going to grow more than this or less than this, right, for the Brickell market, for the Miami market. But what we're doing is we're projecting what the competitive set ADR will be through the end of our 5-year projection period. Okay? And this model assumes 3 years of development. So this will be a little bit different than your projections, because you have a 2-year projection period. Here, right here, the years are a little bit different than the assignment for your group project. Here, we link in our ADR. This comes straight from the projections. And we calculate the index, right? So the index is what is our hotel's ADR divided by the comp set ADR. And we do that each year. So here, this is showing we have an ADR index of 84% in the first year, growing to 103%, 103.6% in the last year. We do the exact same thing for occupancy. We take the occupancy from the competitive set, right, from the custom P&L report and the trends report, and I'm growing it based on the CoStar growth rates. So I have occupancy over the entirety of the of the projection period, I compare it to the hotel occupancy. So I have an occupancy index of 79.9% growing to 103, and do the same thing for RevPAR. Right, RevPAR is just the occupancy times the ADR. So we start out at 67.3% in year one of operations here because we're not stabilized. By year three, we're pretty much on par with the comp set at 99.4%. And in year 4 and 5, we exceed it. I don't know why this formatting is happening, kind of funny. Okay, so that's an important page. And the last analysis I want to talk about, and this you must have in your group project, and you should have in your submissions, is all the way in the back here. I have a comparison. We looked at this, I think last week, maybe it was 2 weeks ago. So here I'm pulling the year 3 projections we have, our stabilized projections, right, straight out of our projections page, and I'm comparing it to the custom P&L. So I pulled the custom P&L, and I'm looking at the margins side by side. So we have rooms expense of 24%. The competitors have 21.9%. So we're more expensive, right? We're operating less efficiently. Does that make sense, right? There's no right or wrong on this page, but you should be able to go through each line item and say we're higher or we're lower than the competitive set, and here's why. Our rooms profit is lower. Why is our rooms profit lower, right? And you have to explain the reason why. Our food and beverage profit is slightly lower. And here our admin in general is exactly on par. Our info and telecom systems very close, right? Sales and marketing, we're a little bit less. Okay, so we need to explain each variance. If there's no real variance, you can say is in line with the competitive set. Here we looked at this last week, I think it was last week, and said the insurance we have is 2% and the competitors are 3.9%, right? So maybe we're too low, right? Maybe that means you need to increase your insurance. None of this means you should be exactly in line with the competitive set, because that's a weighted, the custom P&L data, which is this, pulling straight from the custom P&L report. You can follow the links. All of this is based on the weighted average of the competitive set. So some of the properties in the competitive set have higher expenses, some have lower expenses, but you need to explain kind of each key variance and need to sort of explain why you're in line with the competitive set. So why you're below, why you're in line, or why you're above for every one of these line items. You need a sentence or two for each one to explain these projections. Then we do the exact same analysis, our model, but per occupied room, right? And same thing, you can add into the sentence or two where you're describing why your departmental expense margin is higher than the competitors, right? You can say, well, while it's higher than the competitors, here you have $68 per occupied room, the competitors have 48, right? Why? Because our ADR is a lot higher. Our ADR is 283, the competitive set is 220. So you want to explain the difference in margins, the difference in per occupied rooms, and then on per available room, the only thing you should really explain is the difference, if any, on insurance per available room and property taxes per available room. So this is critical. This is critical to have, because this is the explanation of your projections versus competitors, right? Versus you just creating projections on your own. I would pay a lot of attention to this recording. I'm going to wrap it up in 1 minute, but this is what your group projects should have in the final submissions. This is what you should be prepared to address and be able to discuss when asked questions at your in-person presentations. So with that, I'm going to say good morning. I'm sorry that I am not there with you all in class. I'm going to stop sharing the screen here, and I will make myself available over the weekend and during the the week for any detailed questions. I know some of you have done the submissions of projections already. I will get responses and comments back to all of you on anything that was submitted by Saturday morning. I'll intend to do it. I'm flying back to Miami tomorrow, so hopefully I'll do it on the plane, but if not, by Saturday morning. So sorry to miss you in person. Please pay attention. Please pay attention to this recording because it's really important for your projections and for the final group project.